I'm Samantha Ramirez, and I'm here with Alan Rosenfield, Managing Director of Harmony Asset Management, and this is the May edition of Harmony Asset Management's Thoughts and Comments. Good morning, Alan.
Good morning.
So we're supposed to be doing a review of first quarter, but it's already May, so why are we doing this now?
It's really from a point of view of perspective. What's most important is what's happening now, and therefore what do we think is going on in the future. So we start with what happened, that's the quarter. But right now, right at the beginning of the quarter, you start getting earnings. And that's why we wait till now, because by now we have about 58% of all stocks.
For perspective then, what happened in first quarter?
The big change was we had much more volatility than we've seen in a number of years. The market was up 7.5% in the first month, then it dropped 10.2%. We ended the quarter down 1.2%, and now we're down almost 2%.
So people always want to talk about stocks, but we rarely talk about bonds. Do bonds matter?
They're very important to stocks, but especially since 2008 recession, because central banks around the world started manipulating rates to try and get economies moving again. So they become even more critical.
So what happened with bonds in first quarter, and how did it affect stocks?
Interest rates actually are more volatile than they've been in 10 years. Last year, if you looked at both interest rates and stocks together, bonds kind of traded in a range and stocks were slowly growing. Near the fourth quarter, interest rates started rising more rapidly, but stocks were happy with that because the economy was looking good. So we actually broke 3% on the 10-year. It's down to a 298 right now, but this has made the stock markets much more nervous, and that's when we got the sell-off, and now we're down about 2%. The reason is, while interest rates are still low by historical standards, debt rates, debt amounts have gone up dramatically. In the last 10 years, government debt has more than doubled to $21 trillion. Corporate debt has been rising very rapidly as well. And with corporate debt, they haven't been using it to grow business. They've been using it to pay dividends and to buy back stocks. So the chart you're seeing now is 3-month LIBOR, and you can see for several years it's been rising, and in the last year it started rising quite dramatically. Corporate debt, most corporate debt is tied to 3-month LIBOR. So that rising interest rate is impacting their margins, and that's going to be an issue going forward. Another thing is wage inflation starting to pick up. Unemployment's low, and therefore unfilled jobs are at all-time highs. That's putting pressure on inflation. Now, inflation does not normally kill stock markets or cause recessions, but you've got the Federal Reserve raising rates at the same time. They've now raised rates 6 times since 2015. Higher interest rates can lead to recessions, so that's something else we're watching. Another item is leverage in the stock market. Margin debt's at all-time highs. And margin debt doesn't lead to a bear market either, but if you start getting a weaker economy, people start selling stocks as they're a little more nervous, and then they start unwinding their leverage, it's going to further push down the stocks. Finally, you're noticing what we call a wedge pattern being developed, where stocks had a high, the next high's a little lower, the next high's a little lower, the lows are a little bit higher, so you form a wedge. Typically, when you come out of a wedge, you either break up or you break down. It doesn't mean that we're about to go into a bear market or a recession. It's just one more item that we're watching.
But isn't the economy doing well now?
It is. Most numbers are quite good, whether you look at consumer confidence, ISM numbers, unemployment. Most of the economy is doing well. And for the first time in 10 years, global economies are all growing at the same time. But the real question from that becomes, if everything's perfect now, how long does that continue?
So give us the bottom line. What do investors need to know?
Bottom line, there's going to be a lot more volatility than we've seen in the past. We think there's a last hurrah for stocks. With investors, we're going to stay invested the way we've been. End of the year, we're going to be looking towards what we think next year, whether there could be a recession.
So what about for investors looking for income? What strategies make sense when rates are rising?
We're using a 3-pronged strategy. The first part of that is to shorten maturities. So we've gone from 4-year maturities to 2-year maturities. And because rates are up, we're getting higher yields than we would have anyway. The second thing we're doing is augmenting by using adjustable rates. So they float and adjust every quarter to the 3-month LIBOR. If we're going to see a recession next year, what we want to do is start extending our maturities again, actually, locking in longer rates, because if we get a recession, the Fed's going to cut rates. That's why they're raising them as quickly as they are. So if that happens, we want to have longer maturities so that we've got the yields for a longer time period.
Well, thank you for your insight, Alan. We hope you enjoyed the first video version of Thoughts and Comments, and as always, if you have any questions or comments, you can contact us at Harmony Asset Management. Thank you for listening, and look for our next update soon.